Monday, you could be bearish and like, damn, it looks like we're going to lose the 200-day moving average. Like there's a recession coming. And then by Friday, it's like, oh, well, that was dumb. Why'd I cut all those trades? Like, and that's why you need to have very clear defined rules ahead of time and
Yeah.
know how to respond to them, because the market will do that to you.
Welcome back to the China Shop, home of the Band of Traders podcast. In the last few episodes, Cam's been showing us how he trades, most recently covering screeners and watch lists, but today we're getting into the part that actually determines whether or not you make money, because the truth is, entries are the easy part. How the trade is managed is where careers are made. Now you can watch along Cam's screen on YouTube or Spotify. Let's get into it.
So yeah, I think this time we had talked about there's a couple of things. I guess we could kind of review. You've been following some trades, so we could kind of review those and see if you had any questions around like stuff that you're in and how does it look and how could you, like what you should be looking to do and how could you, like manage it. So, should you be taking profit? Should you be adjusting your stops? And then that could be a good segue into like bigger picture, how to manage everything, not just one at a time. And now that you're in trades and, you're going through stuff and like, oh, a new trade pops up. Like, well, do you take the new trade or do you keep what you're in? Because that is, that's, as someone who actively trades, that's more of where I spend my time. Like my system is refined and the rules are there. I spend much more of my time kind of evaluating, okay, do I keep this one that's up 20% or do I take this new trade that's up 0? But could go 50%. So,
yeah, and that's where I'm stuck at now. I'm in 3 trades and have been sitting in them for 8 days. And so the next step is going to be, when do I cut them for something new, or do I just ride with what I got?
Yeah.
And so why don't we just go through? I've only got 3. It'll take a few moments.
Let's
go through. So the first one is AUXX.
Yeah. Okay.
And so
Yeah,
like you can throw your line up there. Yeah, that's exactly where mine was. And then that's my risk there. And the candle that closes through the diagonal is the day I bought.
Yeah, enter right here. Yeah, that's good.
Yeah,
that looks good. Yeah, zoom out a little bit. So
right
yeah,
at the top of it.
Yeah, so gold, right? So yeah, familiar with approximately what's going on here. Yeah, that's pretty clean chart. Gold related. That's still a good theme. Yeah, it's it's consolidating right now.
Yeah,
but that's something I've been saying in my room starting last year, or starting at the end of last year when I was really taking a lot of profits on gold. I was saying like it needs to consolidate for about the first half of next year, and so we're getting close to that, like through May. That'd be really, really nice. So, but yeah, the chart looks good, clear, strong pattern here, strong move up. Way off the 200-day. So yeah,
way off.
Good.
My next target is at 187, which is that high there.
Yeah, right around there. That's a good spot. That's a good spot.
And so I don't have any reason like to cut it. I mean, if I can do 25% on that, that would be perfect. And then I've got one more just at the at that high there.
Yeah. $2. Yeah.
Exactly.
Yeah. Yeah, I agree. And so this is something we were just talking about it, but so I've been going through with Claude and then the custom AI tool that I built, Jarvis, analyzing and back testing everything. I downloaded 10 years of data. I downloaded the entire market, so 17,000 stocks for 10 years.
Wow.
I spent like a week and a half getting it to understand my full strategy. So what it looks like when I say a high, what does a high mean? When I say a low, what does a low mean? Like really understanding it. Getting it built in. And then so for like 5 days now, I've been back testing the hell out of stuff. Again, I think I'm up to over 400,000 different combinations that have been back tested to help answer some of these questions. Are my rules really correct? Or could they be a little better here or there? And then, but the big piece there, like the strategy is mostly right. Like it was 93% correct. But the big piece is kind of where we're at now, is like, now once you're in the trades, how do you manage them? Because that's the difference between making money and not. And I say this all the time, like 100 traders, we could have 100 people come in here and take this exact same trade, use my exact same rules, and we'll get 100 different results. And to be honest, half the people would lose money. Even on a setup this clean, half the people would lose money taking the exact same trade. A quarter of them, they'd make a little bit, right? Like they'd make a small amount, 10, 15%, maybe 15% or so, 15 people, they'd make, okay money. But then like about 10% of people would really get it figured out and really capture the full potential of the trade. And
Right.
that's the hard part. Because I honestly, trading itself, like there's so many strategies that work. Like, yes, what I do, it works. But I mean, I can give you 20 things off the top of my head that like if you just copy their rules and like you could have AI execute them precisely, you'll make money. But then the management piece that comes in behind it, that's what really determines if you grow your account or if you just kind of go around in circles. So, but yeah, this looks
Okay.
good.
And so my
Yeah, I think that's a
stop
good target there. Go ahead. Yeah.
my stop is now 146, which is the low of
Right about there. Yeah,
the
big candle.
13th. Yeah,
Yeah.
the low of that
Yeah.
day, because that pushed a new high.
Yeah. I'd move it to right here. I'd move it up 153.
Go. Okay.
Yeah. Because see, this is essentially like a small consolidation here, and then it
Yes,
broke.
sir.
So yeah, I'd move
Yep.
it up to right here.
Okay.
I'd move it up to right there.
Perfect.
And then we'll see how things go tomorrow, which would be the 20th of April. Now we're back into war again. We're doing that bullshit again. But
Right. So
so essentially the idea here is every time you get like a new move up and then a pullback and then a rip, pull back and then a rip, when you get that pullback and it jumps another level, like it moves up another level, you move your stop a level. So
Okay.
move your stop another level. And I would say, yeah, here I would definitely have to be at taking a profit. Right. If you hadn't been here on the 13th, yeah, that would probably been a good spot to take
I did.
profits here.
I
Yeah,
took
that's a good-
25%
Yeah. Okay.
and then moved
That's
my
a-
stop.
Yeah. Yeah. 20, maybe 25 is a little heavy, but I get it. Okay. At least 10. Take off at least 10.
Okay.
And the reason why is this candle here, this big rejection. When price gets back to that area, you want to have an order sitting there just in case it rejects again. So again, like 10%, okay, that's fine. And then now it's above it. It cleared it and it's holding above. You got a good close above on decent volume. So that's a good
Yep.
sign. So yeah, now it should be good, knock on wood, to start moving up. And yeah, I agree, around 190, 185 to 190. That's a good spot. I definitely want to be at least a quarter out by there.
Okay.
Then yeah, by the time you get to the top here, half out.
Yeah.
Normally I would say be 75% out.
Okay.
But one of the things that I have learned very recently, and I kind of agree with, is leaving a little more money on the table when you have a good pattern like this in a good trade. So, half out here and then have a good high stop loss. Like and your stop here is well above break even. So you're locking up
Yeah.
money. You're going to make money on this trade.
Yeah.
That's confirmed. It's just a matter of how much are you going to make. And the thing is, like, so this is gold. The underlying asset on gold is still very strong. You want to make sure that if this does continue and it turns into if this goes from, $1.50 to $5, you've got enough on the table that it makes it worthwhile.
Right.
So yeah, I would, somewhere between, the 185 area, take off a little bit more, maybe another 10% when it gets there. And then at the top of the pattern, half. I'd take off half and then look for a good level to have your stop. If there's not a good level for a stop, like if the chart just doesn't give you one, if it's just like really, like if it really takes off, you have two options. So one, I would use either a 15% trailing stop, just like you can program that. Like if it falls more than 15% from its peak, cut it, or use a close below the 20-day. Because that's going to move quick enough to catch most of your moves. And so, even if it pulls back hard, it's not going to completely catch you. But if you use like the 10-day, that moves a little too fast. It doesn't give it enough room to have a little bit of volatility. Like a little bit of volatility is okay. It's okay if it doesn't go vertical. Like that's fine.
Yeah.
So yeah, either a 15% trailing stop once you get up here at the top of the pattern, or the 20-day if it doesn't present you one. But hopefully what you're looking for is something like this. This presents a good clean level. And then if you go back here, so let's say you got in the trade down here. Okay, so here would be a good clean level. It pulls back. gives you a consolidation and breaks. Okay, so you move your stop up to here. And then look, it breaks and it consolidates and it rips. So where does your stop go? The bottom down here. Same thing, it breaks, it consolidates. Where does your stop go? Right here. And so you just keep mechanically chasing your stop until it breaks down and makes lower lows and lower highs. And again, if it doesn't give you that, if it doesn't show you one, then you use, again, a 15% trailing stop. Worst case scenario, let's say you got stopped out right here because it moved up, gave you this consolidation, made a low, came up, and then maybe you got aggressive here and stopped out at like 162. That's fine. Look, it gave you a new setup.
Exactly.
So maybe you were a little concerned here. You were up 100%. You're like, hey, you know what? I really want to lock in my stop. It closed below the 20-day also, and then it rejected it. So you closed the trade. Who cares? You made money. And then look, it gave you another entry. It gave you a setup. You re-enter the trade and go. And if that's the thing,
perfect.
like if you get stopped out, but it gives you another setup, well, just go back, enter the damn thing again, right?
Yeah.
That's all you got to do. You can always buy back in. If you're making money, you can always buy back in. So don't get too hung up on it. So, but this is a good one. This is a good clean one.
And then the next one is AMPX.
Oh yeah, AMPX. Yep.
Yep. And so
Yeah.
that one, I'm in at 1752 is my entry.
Okay, so break
was
that
on
diagonal.
that. Yeah, but it was the next day when it
Okay.
came back down and retested
it. Nice. Yeah. That's really nice. Yeah, that works really well. Doesn't always happen, but yeah, it gave you a retest. Good heads up there.
And it closed above. So that's why it got. Yeah.
Yeah, exactly. And that would be, so yeah, in this scenario, so this is a good one to kind of look at. If you have this pattern here, and let's say you don't have this information, you just have this.
Yeah.
You miss your entry. Where would I put my order? I'd put it just above this high here, somewhere around about 1750, because this is a potential fair value gap. So there's a big move up here. We know there were orders taking place down here. Maybe there's a little bit of room in here for price to come back and fill it. But if it goes too deep, that's, that you don't want to really buy down here because that could be a sign that the momentum has died. So buy up here, and then I would have a stop of that low on what would have been the entry candle.
And that's what I had for that day. It was, I bought it on the way down, and as long as it closes back above, then I was going to leave it. Otherwise, I'd have cut it. Yep.
That works good. Let's see. So all right. So do you have any profits?
This one?
Just yet? So you're up.
Nope. I haven't taken any yet. The first one is at 1939. Right where you are.
Right about there. Yeah, right there.
Yeah.
Yeah, 10%. Yeah, and also that puts you what looks like a little bit of resistance here. Yeah, you're right around there. Yeah. So I'd go about right around here. I'd maybe go inside this little range here, like 1925 or so, just because it looks like it's bumping its head there. So if it gets back up to that level, I'd again sell somewhere between 10 and 20-ish%. Yeah, at least 10%, and then move your stop when you do. Anytime you take profit, you need to move your stop.
Yeah.
Just like rule of thumb. Even if it's just a little bit, right? Like just move it a little bit. You could probably move it up to at least break even. Right? Like at least move it up to that point. So, but yeah, that looks good. And then I think this is clean. This blue skies above.
It's blue skies.
Almost.
Well, that's an IPO. That's a wick.
So
yeah,
that's an IPO wick. You can't count that. That's not real. Yeah. And so that's good. And so that's a good, kind of looking at the next piece from that. Like, okay, so with blue skies, a lot of people struggle with like, where do you take profits? So there are two ways I would say look at it. The first one is a measure based on your risk. So how big was your initial risk on the position? If it was $1, then you want to start, I would say you want to take your profits in multiples of R. And so rules of thumb are basically every 5. So if your initial risk was $1, every $5 you move up, you want to be locking in profits as long as it holds. Just like keep locking them in. And for most things, I mean, if you're getting to like 25 R, you're doing pretty good. Like you want to be pretty much out. But keep selling. If you want to do 10% every 5 R, that works. And again, every
Okay.
time you take profit, move your stop, move your stop. Look, hopefully go for a good level on the chart. If not, like I said, somewhere between a 10 to 15% trailing stop can work, or you can use the 200 day. It's really whatever's comfortable for you. I mean, you can, try and, back test it and get it really, really precise. In reality, like that's never going to happen. You just come up with rules that you're comfortable with.
Yeah.
And some
Okay.
of it is the underlying asset too. So if you're in something like a small cap that has a lot of volatility, you're going to need to be more patient. Like you can't use a 10% trailing stop because that's just Tuesday for a fucking small cap, right? Like that's, like if
That's
Apple
right.
drops 10, if Apple drops 10%, well, okay, well then the market has probably dropped 10%. So Apple
Right.
dropped 10%, like, yeah, you need to, you're out of there. But yeah, a small cap, like, I mean, 10%, like that just happens. So be aware
Yeah.
of what
Okay.
you're in. AMPX, so technology company, it is a smaller company. So you need to have a little more room. And then some of it too is like, look at how it's moving going into the trade. How, what are the candles doing? Is it something that's relatively clean? Gold, you'll notice the candles are a little bit tighter. It's a little cleaner action. This seems to have a little bit more wobble to it, right? This
Right.
is moving a little more like a, drunken sailor. It's got some range. So be a little more patient here. If you're going to move your stop, I would say go one daily low at a time. So go from the low of one day to the low of the next day. And just every time, because again, that helps keep you from having to decide. And that's what this comes down to. Pick a rule so you don't have to decide the level. You don't want to have to like, oh, is it this one or is it that one? Like, are you going to just go every daily low? Okay, well then cool. You just know it's here, it's here, it's here. Is it a 15% trailing stop? Okay, cool. Is it the 20-day moving average? So like get all these things figured out ahead of time because if you're working and you don't have time to do this, right? Like you're just checking
Yeah.
on it during the day and like, okay, I've only got 20 minutes to manage my stuff. Like you don't have time to like do the calculation and look at the chart and figure it out. It needs to just be your rule. You can either pull up on like a little sheet and say, okay, what's my rule? What do I do here? Okay, this is what's going on. I look up my rule and oh, this is what I do. Right. And then
Yeah.
you can keep it moving. Because again, if you've only got, 15 or 20 minutes, and you're checking on your break at work or like the last 15 or 20 minutes of the market and you've got, 5 positions, like you don't have time to do this because you also need to get the orders in and get everything programmed before the market closes.
100%. Yeah.
Any other
And
questions?
so
What are your thoughts here about it? What do you think about it?
for moving my stop up, I've just been kind of going by like the low that brought us to that high. Meaning, so with this one, it's that doji that retests it. So not quite a doji, maybe a hammer. That one
Yeah.
there.
Yeah,
And so that's the low that's brought us to here. So it's just
Yep.
sitting there.
that's fine.
When we make a new low, then we'll move it up again.
Yeah,
But
that works. Yeah, that's a good place to start. Yeah,
Okay.
start there. So,
And then
Okay.
my third one is laser, LASR.
okay, similar.
This
Okay.
one, I think is a poorer trade. So we'll see what that looks like. But so my diagonal was down through where that candle tests that one there. Yeah.
Yeah, I can see that. Yeah, I see that. That works. Yeah, I mean, there's your price support, here's your higher low, breakthrough. This gives you a higher high right there along the 20-day, breaks your diagonal. Yeah, that works. I've got some declining volume going into it too. And then on the break, you do get an uptick in volume, so that's okay. That's okay.
Yeah.
Yeah, and I would say your stop should be probably up here now. Well, if you haven't taken profit,
I did. So there's that
Okay.
gap. There's that gap on the way down
mhm,
up and to the left there, like that second day.
yeah, right here.
I closed in that gap. I closed
Yeah,
a
that's a good spot.
quarter.
Yeah.
I took a
Yeah.
quarter of it there. And so that's something I will change is I'll be a little less aggressive because I was just going, 4 targets. I would
Yeah,
just
that works.
25, 25, 25, 25. But maybe I'll go 10, 20, 50, whatever.
Yeah.
On
That
the way
works,
up,
yeah.
I'll be a little less aggressive with the take profits so there's a little more meat on the bone at the end.
Yeah. But yeah, gaps are good rules of thumb, like always. And then, yeah, look, it gets to that gap and it's like 1, 2, 3 tries trying to get
Yeah.
through it. It hasn't been able to. So from that, kind of the way to read the chart is, okay, it's having trouble with this gap And it's also very close to highs. That gap is also very close to highs. Yeah, take profit and put your stop here, because if it reverses on you, if it reverses, this is where it's going to happen. Right here at that gap, right at highs. And so, yeah, make sure you've got some money locked up. I don't think this is a bad trade. If you zoom back, yeah, so this is a good, strong trend here. I mean, let's go back a year. I mean, yeah, it was at $9. It's at 70. So yeah, no, this is a strong trend, really far off the 200-day. I mean, I could throw the 50-day up here, but I know where it's going to be. It's going to be right here in the middle. Yeah, I mean, this is a clean trend. Bigger pullback here. That's okay. After earnings, declining volume, like I said. No, this isn't a bad trade.
Well, good.
No, not a bad trade at all. One of the things so how far are we off the 200-day? 70% on your entry? Yeah, that's good. That's one of the things that I've tested recently and has come back to be a pretty significant indicator, is how far off the 200-day something is. And I mean, yeah, essentially that tells you how much it's run in the last year. I mean, there are, 250 trading days in a year. The 200-day moving average is approximately your 9 to 10 month return. So, I mean, if something's up very strong for the year, then it's up very strong for 9 to 10 months. And in general, I like to look for stuff that's up 200% for the year. So they kind of overlap, but yeah, how far something is off the how far something is off the 200-day is pretty highly correlated. Mark Minervini, that's one of his conditions for his volume contraction pattern. I think he wants to see stuff at least 50% off the 200-day. It works real well for reversals. That's a really good sign. You want to see something where it moved at least 50% to get to the 200-day for a reversal. And then you take at the 200 to take a reversal itself. So yeah, that's a good sign. I wouldn't say this is a bad trade. Declining volume here, a good pickup, still declining volume. So I would say, if anything, it looks like this might kind of drag out a little bit. And then looking down here, you got earnings. Yeah, that's what it's going to do. This is going to kind of drift sideways a little if it doesn't get crushed because of nonsense going on. I would say, yeah, it maybe comes back and tests this level, hangs around here for earnings, which are 2.5-ish weeks away. Maybe it comes up a little bit, but if you're still in this by earnings, definitely have some locked in. That's the other piece. Like if you're in a trade and earnings start to come up and you've got, you're up 30% or so, I'd take some more going into earnings. Just go ahead and lock in some more, especially if you're in shares, because if you're in shares going into earnings, there's only so much you can do to protect your position. And the easiest thing is just take profits. On earnings, I mean, you might have a 10% trailing stop, but what if it gaps down 20%?
Yeah. Especially smaller companies. Yeah. Smaller names. Yeah.
Small caps, micro cap stuff. I mean, even mid-sized things. Even something like Lowe's, which is, a medium-sized company. Like, it could still move a lot. It could still move 15% on earnings. And so, yeah, you're using that 15% trailing stop and it just gets blasted overnight. So that's the easiest way to kind of hedge your portfolio and your positions going into earnings. I mean, that's something I did recently with Netflix. I talked about it a lot in the room. It ran into earnings, and here's my sells going into earnings. Like, I was taking profit, rolling, I rolled here, locking in profits, because I knew this is Netflix. Like, even though it's a $500 billion company, it could still drop 10, 15% and essentially go almost all the way back to entry. And so, yeah, the easiest thing to do is just take profits. And then, either keep part of your profits on the table. If you're using options, you can do that. But with shares, I mean, like, maybe you could sell covered calls. But when you're new, like, I wouldn't even worry with it. Just keep it simple when you're new. Just take some profits.
Okay. Perfect. Yeah. So those are my 3. That's what I'm in right now. So the thing I've run into is, I remember when we talked before about keeping some of your powder dry.
Yep.
Set aside.
Yep.
And so now I've run into that. I think I've oversized these trades a little bit for the size of the account.
Yeah.
And so I've got $800 on a just over $4,000 account.
Okay.
That's ready for a trade. So I've got like potentially one more trade in there if I find it. But then it turns into, you have to watch that lack mindset where it's like, oh, is this one good enough to use my last bit of money on? Or am I going to wait for another better trade?
Yeah. So couple of things come to mind there. So around sizing, so my 5 rules, the sizing is 3, 4, 5% based on how many entry criteria you meet.
Right.
Um, I'm okay with that, and I'm okay with like 5% being your largest size. The back testing that I've done confirms 5% is a good size. The real issue with going more than 5% size is what you were just talking about.
Yeah.
5% size is big enough to make a material difference to your account if you catch the right trades and manage it correctly. The problem is you just need to be able to take more positions than you can with a 10% size, especially if you're just doing shares and you're going like swing trading. Like you just need
Yeah.
more positions than that when things are good. In a time like right now where like even though the market meets all of my criteria, and we can go through those real quick because that helps with position sizing and managing too.
Yeah, let's do that.
When the market is great, you want to have you want to be allocated. You want to be participating in the market as much as you can. And if you're sizing at 10% with more of a slower moving strategy like this, as compared to something like the gap and go, which we can talk about, which is it's like this on cocaine. Like, it's the exact same
Yeah.
setup. It's just with a little bit of a tweak on how you enter the trades and how you filter for them. With something like that, you want to take more size because they're moving real fast and you're going to be in and out.
Right.
Like those trades, you're in and out in 5 to 7 days. So you can size a little bit bigger, but with slower stuff, yeah. So 3 to 5% normally sizing is good.
And that's
works
of
real
the
well.
balance. That's right. Of the balance.
Yeah. So total.
Yeah.
Yeah, total portfolio size. Yeah. So if you have, a $5,000 account, 5% would be $25. Right? Yeah.
50.
$250. Sorry, $250. I was off by zero. $250.
Yeah.
So yeah, go with that. Try and stick to there. So yeah, maybe you sized up a little heavy, but that's okay.
What I did is I went.
Okay.
My risk is 5%,
Yeah.
and so I took the measure amount of my risk and then said,
Mhm.
okay, so I can use, like, I've got half my account in one of them, right? In
Yeah,
Ampex,
but your total risk, yeah.
because the risk was so small, right?
Yeah, yeah, and that's one of the next things I'm looking to test is measuring performance for sizing based on risk, not portfolio weight.
Yeah.
Because that's typically how I do things. I use options and go that way.
Right.
And I essentially size for zero. So like I size for the trade to go to zero. And so if I take a 5% risk, it will be 5% of the account in options. And I am prepared for that to go to zero. Now, it never happens because I go 5, 6, 7, 8 months down the road. So like it's never going to go to zero. And that helps me keep my risk a lot smaller than it should be in reality. And then the convex upside of options mean I average, my average R per trade is like, 17 or 18 because of that. I have it
That's
over
the
here.
next step.
Yeah.
Step one for now is just go 5% of the
Yeah.
account size. So
Yeah. So that
Okay.
works. So then, yeah, you can do that. And if you're comfortable with that, run with it. I would say, 5% if you're going by portfolio weight. If you want to go by risk and 5% you're comfortable with, that's fine. Again, the issue is kind of where you're at now. You're not going to have enough room in your account if you're playing with shares. So that's a decision you have to make. But here's kind of the framework that I would look at it is start with one thing. So first, your entry criteria. Look at, so the trade that so all the trades you have on the table, were they all, did they meet all 5 of your criteria, right? Were they like A+ trades? They met every single one of your criteria. And they don't have to. You can it is okay to take less than absolutely ideal trades because you're not always in the ideal market regime. So that's okay. And the back test, proves like something that meets, 4 of your 5 criteria or 3 of your 5 criteria can still be a great trade. It could still end up being something that goes 300%. It's just the odds are maybe 1 in 20 of those trades happen, whereas you meet all 5, it's like 1 in 9, 1 in 8 goes and runs. So
I got you.
You can still do it. So that would be the first thing I would look at. Okay, the trades that I took, how good of a trade were they at entry? How tight was my risk? How much money did I put in them? And how good were they in terms of meeting all my criteria? If you get to a situation where you have a new trade that pops up and at entry, it is better than one of the positions you're in, then you're looking at a potential replacement. Okay, then you're looking at potentially swapping it out.
Like
Past
this
that,
one, for instance, this
yeah,
laser. Now it's coming into earnings, and this could be a top for, so they trim this one
yeah. So
if
you
I
have,
find
yeah, you
another one.
essentially, I would say you have three real options if you want to go mechanistically with it. So one, you could just trim everything across the board. Like you could just say, I need $500 in my account to take the size of this trade that I want. So you just trim a little bit of across the board. Like you just take 10% haircut across the board. You could do that. I don't like that. I would prefer looking at the trades that you took at entry and trimming the weaker trade, either trimming it or just killing it and getting out of it. So if it's not profitable, if it's just kind of hanging around and you're only up like 2 or 3% and you've been sitting on it for a couple of weeks, you can kill it. Just get rid of it. Get rid of it, take the new trade. If it's up and you've taken some profit, okay, take a little more, maybe adjust your stop and so you have enough for the new trade. That's, and so that's kind of the other way to go about it. Just looking at, so the first way is just trim everything across the board. I don't like that. The second way is trimming your weakest trade.
Yeah.
Either the weakest trade or, so weakest meaning weakest setup or weakest performing. So if the setups were all the same, okay, they were all good setups, but maybe one is just lagging behind and doesn't turn out, then you go to the one that has the weakest performance. And you can either trim all of it or a little bit. I would say if you're going to trim something because it's weak, just get rid of it. Like just cut it
Fair.
all. Just
Yeah.
cut it all instead of a part, because then it's like, well, I mean, like, should I cut half? Like just all of it. Just like if it's a weak trade and it's worth cutting, then just cut it. And so now you have, a little more capital freed up for whatever trade you're looking at.
Makes it easy too. It's nice and clear.
The other piece that I would say is, let's say you took, in your case, 3 trades. Look at your concentration. So are all 3 of these trades in the same sector? Like, are they all technology stocks? Are they all oil stocks? If they are, then you definitely, one, don't do that. 2, if you've already done it, don't do it again. And yeah, definitely get rid of that. But also consider, am I looking at taking another trade in that same sector?
Right.
No. So my rule of thumb there is no more than 2 trades per sector or theme.
Yeah. And I've
So
stuck to that.
Yeah. So like with AI, AI is a very broad kind of swath of companies. Like you don't want to apply AI to everything. So you could look at, okay, chip manufacturers, AI energy supply, component makers. So maybe not like the chips themselves, but maybe something like Corning. So GLW, they make like glassware that goes into computer screens and chips and things like that. Or you could look at like ASML. They don't make the chips, but they do photolithography. So again, they're a component manufacturer for chips. So, but however you're going to categorize and however you're going to slice the market, stick to it ahead of time. Don't try and like reverse engineer and justify having 10 trades all in AI because like, oh, well, this guy says they're in the same sector, but this guy says they're different. Come up with however you're going to sort the market ahead of time and stick to those rules. So yeah, no more than 2 per sector. So that can help you, right? If you've got 3 trades on, 3 trades and you've only got room for 4, but you're one you're looking at, like it's closely related. Like, no, it's not chips, but like it's still an AI type thing. Then that's a decision to make. Like, okay, do I really want to take another one? Because if regulation comes out or, NVIDIA says their sales have fallen all of a sudden, or Anthropic's Mythos comes out and all of a sudden it scares the hell out of everybody because it has emergent thinking, which it does. The topic for a whole nother thing. There's actual emergence in AI now. And so maybe the whole AI sector gets tanked, right? Like you want a little bit of diversification there. So that could be something to consider too. If you're, or even if it's just technology, like technology, high beta stuff in general, do you want another high beta name? Or do you have a potential, like maybe Kroger, like maybe a grocery store, which is a little bit more defensive, right? Like, do you want to take a trade over there to give you a little bit more exposure? So, I try to give people ways to think about things, like frameworks, stuff that makes sense to you instead of just saying, here's the answer. Because unfortunately, like I was a consultant. And so one of the things people hate about consultants is we always say, well, it depends. Well, unfortunately, it depends. It depends on what's going on.
Right.
And then, so the last piece that I would say there, and I think this could be a good segue, is it does depend on the market regime also. Always need to come back to broader context. How is the market performing? Has the market environment shifted? If the market environment is shifted and it no longer meets your criteria, then maybe you shouldn't be taking any new trades. Maybe you just sit on your hands, move your stops up, and just let things develop. So does that all make sense? Any
100%.
thoughts?
Yeah. That's my thing is I'm trying to do both markets, US and Canada.
Mm-hmm.
And the theme of no more than 2 per sector. When you come to Canada, we have two things. We have energy and we have metals and minerals.
Metals. Yeah.
And so you only get 4 trades.
Yeah. Yeah.
But
I get that.
But that makes it easy though. There's so many options in metals and mining that I mean, it's easy to cut one and take a better one.
Yeah.
Or just leave one on the watch list.
Yeah. Okay.
And then all of the other things that pretty well have to go across the border for.
Yeah. Yeah. So again, and that's part of it. Like, you have to understand the universe that you're operating in, what your available assets are and how the rules function there. I trade the US market exclusively. I don't know if I'm going to start trading the European markets, when we relocate. I'm probably just going to stick to the US for a little while until I learn other things. But, I will say that the rules of trading, they apply everywhere, right? That they work on the Nikkei, they work on the Chinese stock market. For the most part, the Chinese market is not actual capitalism. Like, there is heavy government intervention there. So if you study it and actually like go through and do like the efficient market hypothesis and stuff like that, and even do like a Black-Scholes model, like it comes out very different in the Chinese market because it's not as pure capitalism as ours is, even though ours is not pure either. Don't come at me about that. I know our market is not pure capitalism either. Our market. I know the US market is not pure capitalism either. But you have to, the rules of trading, of looking for momentum, how to manage things and take trades. In general, they apply to everything. They work for crypto, they work for Forex, high beta, low beta, high alpha, like they all work the same. So,
right.
But yeah, we can go through a little bit of kind of how I would look at the market itself. Like, when is it safe to trade? When is it not safe to trade? Because that's something that happened. I think in between the last time we recorded, it actually went from being safe to trade to not, to back being safe to trade again.
Yeah, it did.
So the first thing I would look at, so we're looking at QQQ here, and forgive the lines. I put a hypothesis in the room of where I think the market path is going to be. So feel free to test me in the future as to if this actually played out. This little drop here definitely looks like it's happening. But the first rule of thumb that I always have for the market regime is the 200-day moving average, right? That is the line in the sand, okay? In general, above the 200-day moving average, you're good. In general, it is good to trade. And this starts with kind of index investing. So if you're the absolute laziest trader in the world, you don't know what you want to do, you don't know how to pick stocks, you just want to trade the indexes. If you just go with the NASDAQ 100, that's an index. Okay, QQ here is the ETF for it. I don't know if it's actually the NASDAQ 100, but it is an ETF that tracks the best technology stocks on the US market. I think there may actually be a subtle difference. If you just do that and you use the 200-day moving average as your entry and exit, you only hold the index when price is above it. When price is below, you close it. You double the returns of the market. Okay, so the average return, the compound return on the Qs since its inception is about 7% per year. If you just use the 200-day moving average, you'll go to 14%. That's all you got to do. You beat the market. When price goes below the 200-day moving average, you sell and you go to cash and you wait for it to get above. You missed .com crash. You missed the great financial crisis. You missed the crash in the 70s. In 1929, where the market fell by 90% and it took 25 years to recover, you would have been underwater. You would have stopped out with like a 12% loss. You would have been in cash for 3 years, and you would have bought within 10% of the bottom, and you would have had 20-year upswing of growth where everyone else was literally underwater for 25 years. in 1929.
Phenomenal.
Now, different market back then. Okay, I don't think it's fair to
Absolutely.
compare. We have, automated trading now and different margin rules, different brokerage rules. Okay, so it's really not fair to compare to back then. I think you really got to pick up at 2000 for market comparisons. But again, the 200-day moving average saves you from all that. It's real simple. Prices above you buy, prices below you sell. If you want to go one step further, add in gold. So you either hold the index long or you hold gold long. So when price is above the 200-day, you hold the Qs. When price is below the 200-day, you switch over and buy 100% gold. If you do that, your returns go from about 13% a year to 19% a year.
Okay.
So still only one decision. Do I hold the
Right.
index or do I hold gold?
Yeah.
And you beat the hell out of the market, right? I mean, people always say it's hard to beat the market. No, it's hard for hedge funds to beat the market because they have tens of billions or hundreds of billions of dollars. And it's hard
Right.
to allocate that much money. But for retail traders, it is not hard to beat the market. That infuriates me when I hear that. It is not hard for you to beat the market. And if you're a trader, honestly, and you're not making 100% a year, you need to find something else to do because you're not a very good trader. You should be making 100%. You should be making 100% a year just with shares, not with options, not with leverage if you're trading. So, and I can help guide you there. So the first filter here is the 200-day moving average. Okay. So big picture,
Right.
when price goes below it, you want to get out of pretty much everything. So anything that you're holding when price goes below the 200-day moving average, you need to have a reason to continue holding it. My reasons would be, so what is causing the market to go below the 200-day moving average? In this case here, it was, the war with Iran. So what names are recovering and doing well? If you were in those and you got positioned ahead of time, keep those trades on. So like fertilizer, wheat, oil. Okay, yeah, those decided to rip when the market tanked. So yeah, you can keep those. Anything
Right.
else? Anything else that showed signs of weakness, kill it. Get out of it. Go to cash and wait for the market to recover. So that's the first broad strokes filter.
Right.
The
Yeah.
next one here on the chart is the red line. That's the 20-day moving average. And simple, 20-day simple moving average, and this is a 200 simple. Okay, on the daily, don't use an exponential. If you're using an exponential on the daily, you don't know what the hell you're doing. Daily averages
enough.
move slow. Daily averages move slow. They're a daily
Yeah.
average. Why are you trying to do something that moves fast? Use EMAs on lower time frames. Cool, absolutely. Higher time frames, daily, weekly, monthly, just use SMAs. So 20-day SMA. So let's say the market is above the 200-day moving average. Everything's going along great. So like back in here, last year, August, September, everything looks good. When price gets really extended, do you start saying, okay, maybe we're topping out. Maybe we should start being careful. When price loses the 20-day moving average and the 20-day moving average turns down. When
Okay.
that happens, you can still take new trades, but two things happen. One, you size down. Okay, so if you're going to take trades when price is below the 20-day moving average, cut your size in half instantly. And your profit taking, you take profits twice as fast. So if you were taking profits, your first profit at 20% normally, now you take them at 10, and you take half size of your trades. Because there are still trades that will work in this environment, but notice when we cross below the 20-day moving average on the Qs, what did we do for the next 3 or 4 months? We pretty much went nowhere. Now, there were some trades that worked, but in general, this is a sign that momentum is leaving the market. And so it pulls back, and then down here, look, it gets above it, and then we're above it for a little while. The 20 days moving up, and then it starts doing this zigzag thing. So, the last 6 months or the first 4 months of this year, maybe the first 3 months, were really, really hard because we were just jumping rope with this 20-day moving average. And it was very, very difficult. So when that starts happening and you start getting this signal, there's one other thing that I use, and this is a breadth indicator. So this concept comes from Prateek Bondi. He's known as Stock B. Okay, so you can look him up on Twitter or whatnot. He's been around for a long time. He's mentored a lot of very successful traders. The concept is you're looking for a strong momentum follow through in the market. What you're looking for is, I use the Russell 2000. So it's the 2000 most liquid stocks on the New York Stock Exchange. You want to see 4% daily change or higher, and you're looking for a quarter of the index to be up. So that's 500 of the Russell 2000 to be up at least 4% or more for the day.
Okay.
What this is in practice, I think the easiest way for people to understand it is, think about like when you were growing up, hopefully you had someone help you learn how to ride a bike. And when they're teaching you how to learn a bike, ride a bike, like they have their hands on the bike and they're like helping you along. And lots of times when you go for the first time, they give you a little push. They give you a little shove to give you some momentum so you can kind of get going. That's what this breadth indicator is. It's a push for the market. And it's 4%, not like 2%, 4%. Okay, because the average move on the Russell 2000 of a stock is 1.3%. So this means you're getting a significant move outside of the normal. It's a sign that there is follow through in the market.
Okay.
Now, when that signal fires, the average return over the next month for the Russell 2000 is about 6 to 7%. Okay, so that's a very good indicator that there's going to be some follow through in the market. There was not a breadth signal anywhere from, I think the last one was in September. I'm pretty sure it was right here for the Russell, or no, this day, 2000. And then the next one did not happen until right here, 31 March.
Okay.
So yeah, so if the market starts doing this side to side stuff, look up if you can, if you can find the information. It's difficult to find. You have to track it yourself most of the time. When was the last breadth fire? And so this is something I track. I can look it up. But if you're starting to do this and you're not seeing that breadth indicator, and you just check this at the end of the day every day, and the number is like 100 or 120, okay, it's bad. The other piece to look at during these side to side eras is what is the ratio of 4% gainers to 4% losers. If the ratio of losers to gainers is 4-1, so you have 100 that are up 4%, but 400 that are down 4%, then that's definitely a market you don't want to touch. Just sit it out.
So how do you find that?
So this is on TradingView.
Yeah.
But the filter is simple. It's the Russell 2000. And you want to look for daily change of 4% or more. So you have to look at it at the end of the day. And then when the market opens the next day, it's going to reset. So you look at the change of up 4%. And then I would look at below 4%. So in this case, it was like 450 was our ups. And then look at our downs, 65.
64. Yeah. Okay.
64, 65. So the ratio of winners to losers in this case, 4% ups to down, it's very strongly shifted to the positive.
Yes,
and look at what the market
eight times. Yeah.
So look at what the market is. But back here during this period, it was the opposite. It was like 3, 4, 5, 6 to 1, all going the other way. So that's another indicator that you don't have to think about it. Like it's just a hard and fast rule. When these fire, the market is good to go. So with the breadth indicator, the other piece that I will point out that can be very helpful. Usually when this fires for the first time after the market has lost the 200-day moving average, it happens within 3 or 4 days of the bottom of the market. It may be 3 or 4 days ahead of it. It may be 3 or 4 days behind it, or in front of it or past it. But it usually happens pretty close to the market. If I'm sitting in cash and like, hey, it's not a safe condition like it was back here, right? Like we were pretty much just sitting on our hands waiting for times to get better. And all of a sudden you get this signal fire, I'm paying attention now. Now I'm really looking at the screeners. I'm really making a list of names. Like, okay, I really want to have my setups figured out. Like, okay, do I have enough cash in my account? Can I move over a little bit more? I start putting alerts in. I maybe start even automating some stuff, like putting in orders above setups that are obvious, because again, that fires, and the last one was right here. It was on the 31st. So it wasn't the bottom. It doesn't usually happen on the bottom. Again, it's usually in front of it or behind it. But then 3 or 4 days later, what happens? We get above the 20-day moving average, and then it starts ticking up. Those things are very, very highly correlated. This breadth signal and then price getting above the 20-day and the 20-day moving up. I think the multiple R squared is like, it's like 0.81. So there's like an 80% correlation between them happening in that order. The breadth signal will fire first, price will get above the 20-day will move up. And in this case, it was a shallow pullback. So we got above the 200-day, like everything happened all at once.
Yeah.
But in a situation where like maybe it was a bear market and we were, the market pulled back for like, a year or year and a half, that would be your signal for when, okay, we can start taking trades again. But even when you start taking trades again, start slow. Don't just jump back in and start like 10% options, like micro caps. Like, no, ease your way into it. Like even when things look good, okay, take some smaller size, take profits a little early, because that is usually the most dangerous period in the market, is when it's trying to recover.
Right.
So what you want to look for is it tries to recover, you get a retest, and it holds. And so what does that give you on the daily chart? A higher low and then a higher high. That is always your confirmation. When you get that higher low and that higher high, everything else is fired. Now it's pretty much good again, unless somebody comes out and decides they want to go back to war again, in which case it's like,
yeah.
So, but all that makes sense. It was a lot to go through there.
Yeah, and you check that breadth? Do you check it daily, or like when would you decide to check it? Because when it's like gyrating back and forth here, like it was in February and March, are you checking that every day?
Yeah, during this time here, where it's like price is above the 20-day moving average, and then we lose it, and then it gets back above it. Like, I want to know this. I want to check, and it's just end of the day. I just check it.
Yeah,
and honestly, Jarvis, my AI assistant, he reports it to me every day. I get a report at the end of the trading day every day now of just like key things I'm watching, and so I know. And if it fires, it's like called to the top of the list, like, oh, there was a breadth indicator today. But yeah, I'm checking it every day during times like this when things are good. So once we've recovered, prices above the 20-day, we made higher lows, higher highs. I'm not really concerned with it anymore. When times recover. But yeah, once things start going sideways, that 20-day moving average starts flattening out and price starts doing something similar to this. So let's go back to another time frame. So when it was, beginning of 2025, same kind of thing, right? Like we have a good strong run up, we lose the 20-day starts going sideways. Now I'm checking it again. I'm checking, just watching to see, and I'm looking at the ratio of like gainers to losers. If it's a fairly even ratio or still actually positive to the gainer side, okay, like maybe I'm not super concerned with it. But yeah, when we lose the 20-day, like here, again, my rules kick in, cutting position sizes in half. I'm taking profits quickly, looking for the ratio of that breadth signal. And yeah, if you haven't seen it in a while and it starts to really get skewed. So that's basically, you have a lot more losers than winners. Usually that's a sign, like at least in terms of trading, it's time to sit on your hands because it looks like there could be a real deeper pullback in the market. And again, all you can do is trade the chart in front of you, all right? Like, one day it could look terrible. The next day you get that breadth signal fire. And by the end of the week, the market's ripping and you look stupid. On Monday, you could be bearish and like, damn, it looks like we're going to lose the 200-day moving average. Like there's a recession coming. And then by Friday, it's like, oh, well, that was dumb. Why'd I cut all those trades? And that's why you need to have very clear defined rules ahead of time and know how to respond to them, because the market will do that to you. It'll whipsaw back and forth, and mentally it can get to you and it can really affect you. You start doubting your rules and doubting your system. And you just try and start doing this like gunslinger Rambo thing, if people even know who Rambo is anymore. So have your rules ahead of time, know what your response is going to be. Everything I just talked through, I have cheat sheets for, like, okay, when this happens, what is the adjustment? When we lose the 20-day and the 20 days going sideways, two things. Immediately, size in half, take profits twice as quick. Okay? When we lose the 200-day moving average, no new trades. Only keep things that you're in and only keep things that are moving inverse to the market. So even if you're in something and it's profitable, if it starts turning over when the market turns over, cut it. I don't care if you still got 5% more to your stop loss. Cut it. Get rid of it. Okay. So yeah, I think right now, definitely a good time to be going through the screeners that we've talked about. So I'll pull them up here. I have them right here. The 20, 50, 200. Yes, save the changes. God. So the 20, 50, 200 screener, go through that, up 30% for the quarter, 200% for the year, price above $5. Go through them, start looking for setups, paper trade some stuff, pick things. And look, the great thing about paper trading is they just take like 5 or 10 things, right? Like, just take 5 or 10 of them and watch them and see how they're doing. Look at the sectors with things right now. So you can use this screener. The other one we talked about was a monthly one, which is real simple, 50% for the month, or for the week, 20% for the week. Look at what sectors are doing well, especially on the monthly basis. Like, where is the money really rotating into? And start watching those. So start watching the names that are doing well, but also look up some other things in that sector that maybe haven't hit the screener yet. How do they look? Like, are they setting up and they just maybe haven't like technically triggered the screener yet? But maybe, you know, if they just move another 5%, they will. Maybe they will hit the screener. In that case,
Right.
you could, those are potential setups, right? Like, it's just like,
Yeah.
you know, technically they don't hit all of the screener. So go through those, look for things. Again, paper trade stuff. In general, look, I know there's a lot of news going on right now with like the war, and it's hard. Just turn it off. Just try and turn it off. Try not to pay attention to it. I mean, some things you can't, like some things you can't get away from. They're going to be there, but really focus on just playing the chart you have in front of you, because you know, I think it's helpful for people to kind of take a step back and like first principles. What is it that you're looking at on the chart? You're looking at price action. Yes. Okay. Well, who determines the price action? Well, it's the market maker's algorithm and AI now. Well, what are they responding to? The macro. They're responding to news. They're responding to policy decisions and regulations and, you know, stuff coming out of our government and out of the EU government and China. They're responding to the war. They're responding to, you know, private credit reducing redemptions and banks not letting people get their money out. They're responding to the Federal Reserve, you know, board members coming out and talking, and what do they think interest rates are going to do, and where is GDP? You know, GDP came in really soft. The market is doing all of this for you. You don't need to do the analysis. The market does it for you. You just need
That's
to
a
learn how to
crazy
respond to it.
perspective.
That's
a
what's
perspective
going
that
on.
people never think about, right? So the market is
Yeah.
already telling you what's there. I never even thought of that.
It's you don't need to figure out what's important. The market tells you what's important.
Yeah.
Especially now. Now, look, 50, 60 years ago, maybe not even that, maybe 25 years ago, right? Before the internet really turned into what it was going to become, where it is now. Yes, there were opportunities where you could do like real first person research, kind of like the guys at Dumb Money, Chris Camillo and that crowd, like really figure out like trends in the market that have not been exploited and arbitrage opportunities in the news or in like consumer sentiment and things. Like, yes, you could definitely do it. But what AI does is it shrinks time. AI compresses the time to move electrons. It doesn't affect anything when it comes to moving atoms, right? Like AI does not help you weld two pieces of metal together any faster. It does not help you change a pipe fitting any faster. But it does help when you need to move electrons, so like digital things, faster. So the market is going to get even better at pricing in these events and pricing in news. And the market is moving to, I mean, it's going to be a 24/7 market. The cash session will not be 24 hours a day. So like charting, opening and closing price action will still matter. But, you know, we're moving towards a, you know, what is it, 6 days a week, 24/7 market. But look, futures are already 23 hours a day, right? Like, and they still follow the same rules that we use now. So yeah, to land the plane, yeah, like AI does all of this for you. So you don't need to try and figure it out, right? Like now, look, if you're interested in a sector, or you see news that like, hey, there's potential regulation coming for like the nuclear sector, like nuclear energy. Okay, maybe now you want to start paying attention to those names, and you want to look for those names in that sector. So that's something that people can do if you want to look at like, okay, what is in the news, and start looking at that sector for potential setups. Those are good exercises, but for in general, like really try and just set off, put the news aside, build out your rules, think through like your position sizing. Are you comfortable with a 5% position size? Are you comfortable with 10%? Think through, okay, you've got in a portfolio of 10 positions, kind of like Joel, the position you're in, and you're pretty much maxed out. Like, what are you going to do when a new trade comes along? Like, so kind of walking through all of this stuff ahead of time. Okay, maybe you don't know the answer. So you're like, okay, well, how do I think about the problem? What kinds of things would I want to use to help make this decision for me? as a new trader or as someone who maybe not new but is struggling, those are the kinds of questions I want to figure out. Because look, I can tell you how to take the setups. I mean, like, look, I'll give you the screeners. You find the screener, you look for a pullback, you draw a diagonal. When it breaks the diagonal, you enter it. That's trading. The hard part is everything after. For a crude example, right? It's like having a kid. The easy part is making the kid. Like making the baby is easy. Everything that comes after, that's the difficult part. Trading's the same way. Like the actual doing the act itself, it's easy. You just click buy. But then, managing it and coming up with your rules and, okay, how do I know when the market shifts? And how do I know when I need to just like maybe take a step back?
Yeah.
I don't think people spend enough time on that. They get too obsessed with the strategy and the optimization and having 15 different indicators, and they don't think about what really matters, which is you make money and then how do you manage the money. Hopefully that makes sense.
Perfect.
But that's where I would say spend time and ask questions.
Yeah.
Ask questions around that kind of stuff.
Awesome.
I think if you take one thing away from this episode, it should be this. The market has already done the analysis for you. So build your rules, trust your process, and please spend more time on how you manage trades rather than how you find them. If you found this useful, share it with someone else who's trying to figure it all out, and we'll be back soon with another episode. This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.